Welcome to the Drill Down, in-depth answers to oilfield questions. I'm Richard Spears.
I'm John Spears.
And we're going to just turn everything on its ear because for a week,
yes,
we, our clients,
yes,
our listeners, the office staff, the entire corporation in North Tulsa called McElroy, everybody's been arguing about the puzzler from last week.
It's Stump the Oil Patch Week, yeah. So
because this is the very first time in a year or whatever of doing this that we were flooded by answers. And we were stopped in the street.
Yes.
And
no one can agree. They're all different.
Every answer is different, and
yes,
the only person who got the answer right was you.
Apparently. Yeah.
Now, I was in a meeting last week where I presented it to an entire corporate structure.
Yes.
And the answer came out, but nobody could agree on it. And I'm not going to count that as a win.
So tell us about the puzzler. To recap the puzzler for us.
And you can argue about it all you want. By the way, one of the people who submitted an answer submitted it with not one, not two, not three, not four, but four attachments or 5 attachments. Another argued about the entire ethics of the thing. Another argued about boomers.
Slightly off topic.
But, but here was the question.
Okay.
We opened up a bakery,
right.
And a customer came in one morning, and she wanted to buy a loaf of bread that cost $1.
Yes.
So she gave us a $10 bill. We didn't have any change in the door. We had a lot of other 10s. So I ran over next door to the laundromat, took the $10 bill, exchanged it for 10 $1 bills, ran back.
Yes.
And then you handed the gal the loaf of bread, 9 $1 bills.
Yes.
And we put that precious remaining $1 bill.
As we were framing it, then the lady from next door came back.
And she's mad as hell.
Because?
It turns out that the $10 bill we gave her was fake.
A counterfeit bill.
And so we went, crap, it is. And since we're ethical people, and one of the answerers said we're very ethical. We gave the laundromat gal a real $10 bill out of our cash register.
Yes.
And then so the puzzler was.
And then we ask ourselves the question: how much money did we lose?
How much did we lose? And that was the puzzler.
Yes.
And we got. Not every answer but we got $9.
Yeah.
We got $19.
Yes.
We got
$1.
We got $1. We got answers that had, well, what's the variable cost of a loaf of bread? But the real answer, John, I will let you explain.
I think the easiest way to think about this is recall our engineering days and mass balance equations.
There
are 3 people in this story. So the counterfeiter, let's call her that, left with a loaf of bread and 9 $1 bills, right?
So she had essentially $10 of value that she walked out with.
The laundromat lady, the lady from the laundromat, ended up breaking even because she gave us 10 $1, but then we gave her back $10. So she broke out even. Right?
She's even.
So the only other person in the story is
That's
us, the baker. And the baker must lose whatever the counterfeiter won, right? So ergo, the
$9,
$9 $1 and a loaf of bread. Yes, right.
Which I argue is worth $1, and you argue is worth what's the variable cost of a loaf of bread?
Yeah.
But it's $1.
Anyway, but I think that's the right way, the simple way to try and figure out what the answer is.
So we have started today's podcast with the answer to the puzzler, which is opposite of what we normally do. It's because we're all still riled up about it.
Well, I think more people are interested in the puzzler answer than what we want to talk about today.
Which is what?
Well, the topic at hand is, how do we, you and I, expect U.S. operators to decide how to allocate next year's free cash flow? Because this is the time of year when companies all across the board in the service industry are thinking about what will 2022 hold, right?
If you look at the history of our firm and our forecast of drilling activity, we bring it out every quarter.
Every quarter.
And the September quarter presentation, when we used to do it in person, was always the biggest audience.
Oh yeah, absolutely, because everybody was right in the throes of planning for the coming year. So topical.
4 weeks from now,
right,
everybody's going to be in the throes of how we allocate.
We're going to get
capital.
a lot of questions. I've been thinking about that. And so, in the old days, our forecasting technique was to
spitball. Oh, wait.
No,
sorry.
we linked activity was typically very strongly linked to the change in oil and gas prices, right?
Right, not the price itself.
Right, but the change.
But the change.
Right. It went up 10%, right? But these days, of course, we've been talking about this for some time now. Operators have changed their approach, and instead of chasing production and volume growth, they're chasing profitability and return to shareholders and things like that. Yeah. So
and they're doing a very good job.
They're doing an excellent job of it this year. It's the first half of the year. The results are in, and there's been some outstanding examples of how oil companies are turning around. We track about 30 of them. They're publicly traded, so their numbers are presented each quarter, and we assemble them and see how that group of companies, which represent about half the spending in the U.S. oil patch, how they're doing.
Would this be, for example,
Pioneer, Devon, EOG, Conoco?
Okay.
Go down the list, right?
Yep.
So, so we look at those companies, and so here's this year's numbers. We're looking at what is it, $65 to $70 spot price, I think, for the balance of the year. So if we sort of use those numbers and roll in what we think will be production levels and what it appears, cost of services and so forth, it might, round numbers, it looks like this group of companies that we track is going to have about $76 billion worth of cash flow from operations
in this
2021. Yeah,
2020,
absolutely right.
$76 billion in positive.
Yeah, cash flow from operations.
Flow.
Yeah, right, absolutely. What are they doing with it?
All right,
that's your next question, right? So the CapEx piece, the part that they're spending on rigs and wells and production systems and so forth, is going to be somewhere in the vicinity of $32 to $33 billion. I'm
going to write down 33.
Okay,
and that leaves us $43 billion.
Something like that. So they're spending about that 40% that they're spending on CapEx is half the rate that was getting plowed back from 2 years ago, from 2019.
You can see that in rig count. I got 500 rigs instead of 1,000.
Yeah, there you go.
So what do they do with the $43 billion?
The debt retirement piece looks like it's on track to come in around $20 billion this year.
So I subtract $20 billion from the 43, and now I come up with $23 billion from these guys.
Yeah. What are they doing with that? About half of that is going to cash balances on their balance sheet.
So I'm going to call $13 billion goes onto the balance sheet.
So that would leave the rest for
$10 or $11 billion to give back to you.
To me, the shareholder, yes.
Absolutely. You so get the $10 billion.
So that's roughly how it's being allocated this year, as best I can tell. It's on the first half of the year, and then our guess is to the second half of the year. So here's where you get to opine. Pick an oil price that you think for 2022.
I think you can hang your hat on 70, and you might be able to hang your hat on an even higher number. I'm going to say 70.
Well, the forward strip is at $64 today.
Well, when's it ever been right?
Well, that's a good point. But I think when operators are asked, well, what price are you going to be budgeting around, it's pretty easy for them to say, let's use the forward strip. We have 64, 65.
So you want to use that?
I've said let's use 65.
Well, then why'd you ask me to pick a price?
I just wanted to see if you agreed with me or not. So. It was worth a shot.
It's been this way our whole lives.
So at a $65 price,
at 65.
And then again you have to make estimates as to production levels.
It's very similar to this year's price.
Yes, this year's price will end up being, because we were in the mid 50s at the start of the year, we've been higher than that. So the average for this year is going to come in right around 65, it looks like. So if we say $65 price for next year as well, then not surprisingly, the cash flow from operations number will look like $80 billion or thereabouts.
Very close.
Yeah,
this year's a little bit higher. Now what are we going to do with CapEx?
So I think the CapEx number is on track to increase about 20 to 25% next year. So if it's $32 billion this year from this group of companies,
that's another
40-ish
billion.
40 billion. So
all right, so I'm going to take $40 billion and subtract it from the $80 billion.
That's right, exactly.
That leaves me $40 billion.
Yeah, right. Okay. So now, interestingly enough, I don't think that a 25% increase in spending for CapEx, I mean, what does that really get you in terms of more wells and footage? Because we also
it's getting a little more expensive every time you get a rig out.
Yeah,
every time you get a frac crew out.
The rate that's increasing at would suggest to me that over the next year we're looking at 10 to 15% on price alone.
So
things get more expensive. So a lot of those dollars get chewed up just in the form of price. But again, I think that kind of makes sense because it seems like a lot of operators are saying to their investor community, we're going to just do maintenance capital. We're just going to hold production steady. We're going to wait until OPEC, exhausts all those surplus barrels that it's holding off the market.
Yeah.
And at that point, we'll begin to try and ramp up our own production.
There will be the odd fish swimming the opposite direction. But
Always.
for the most part, one more year of this, or at least another year of this.
Yeah, I think so. Because you look at OPEC and how they're ramping up production. It'll take them another year before they sort of put all their barrels back on the market.
So we pay off $20 billion in debt this year.
Right.
And we pay off another $20 billion in debt next year.
I think maybe we go down to $15 billion because the other part of the thing is what kind of leverage on balance sheets
You got to have
companies?
some.
Yeah. A year ago at the end of 2020, this group of companies collectively had leverage of a little over 50%. What do you think? I mean, at 2 years, this year and next year, if they retire debt at a rate of 15 to $20 billion a year, they'll get down to a leverage number of 30 to 35%, I think. So I think they've got maybe another year of deleveraging their businesses.
Debt is about where it should be for an industry that is viewed like we are.
Yeah, I think
so.
so.
Okay, I'm going to take $15 billion.
Yeah, right.
Of debt reduction. That leaves me with $25 billion.
Yeah, right. Now, I think at this point, companies probably don't continue to add cash to their balance sheets.
And they don't add cash to the balance sheet because that makes them very attractive to a takeover.
Right. Yeah, there you go. So if they're basically spending somewhere in the $10 to $15 billion this year in terms of shareholder returns, that number could go as high as $25 billion next year.
Because here's what I'm going to do. I'm going to say that $5 billion goes onto the balance sheet.
Okay, right.
Because it got to put some on there.
There you go, right.
And that leaves you $20 billion to distribute to shareholders.
So about 25% of your cash flow is going to shareholders. Another 50% is going to activity. Yeah. And then you've got 20% or something like that to debt retirement. So I think that's kind of where these publicly traded U.S.-focused oil companies are likely to head.
You know what I'm going to do?
What's that?
As soon as we get done recording the podcast, but before we put it into the public, I'm going to buy a bunch of shares of public E&P companies. Because if the dividend number looks even remotely like that, then this is like a little retirement fund.
Well, some of it will be dividends, some of it might be share buybacks, that kind of thing. So both of those numbers could take place, and probably will. Now, the wild card in all of that is, will some of these monies go toward asset purchases? Will we see further transactions take place where companies buy assets from other companies, buy other companies? What's going to go on there? Because there are clearly going to be some companies that have the kind of financial firepower to get that done if they want to.
Sure. Today's announcement of Chesapeake buying Vine, which is,
there you go.
The Vine shareholders, I presume, will get some cash. So, mission accomplished.
Yep, right.
For those.
So that's a wild card. We really haven't thought through that because it's who knows. But I think that sort of puts some of the parameters around how big is the bucket going to be for all that free cash flow, and how are the shares liable to be handed out next year? Because I think the two overriding goals that operators will have will be to reduce their leverage and return cash to shareholders, and B, to basically hold production flat. I think it's very tough for them to make the argument that they need to be raising production now. So
what I wonder is, this is the corollary to what you said, and you don't have a fulsome answer, I don't think. But this is the E&P companies, and it describes a situation where they are some of the financially most healthy companies in the United States, I think. But they are surrounded by service companies who are, think of it as doing all the heavy lifting.
We could talk about service companies and where they stand in their financial recovery next time.
I think the big point is that the service companies don't recover at the same pace.
No.
There's a lag factor. Yep. And a way to think about that, the way to think about that is the service companies have a lot of work to do, and it's up to them to figure out, I'm doing a lot of work, I'm going to figure out a way to make some money in the process. Yeah,
you think about what oil companies have done. They have obviously trimmed costs, reduced fat, whatever those words are, and that's helped their profitability. And certainly oil service companies have done that. Oil companies have benefited from a rebound in the price of their commodity, the price of their product. And we haven't seen that piece yet take place over on the oil service side. So that's one of the reasons, I think the main reason why the service sector is a little behind here. But I think it points toward increasing activity for 2022 if everything else holds together. And if that's the case, then we'll just we'll look forward to the next year.
There's clearly already situations where those people who provide equipment into the oil field, whether and this would be rented equipment, that there's it's getting towards the end of their use of the usable life. Directional drilling systems, if you will. The drill bit industry has pretty much run through their inventory of built
some of the
spares.
things that we would look to as straws in the wind, as it were. Right?
Yep. So those little canaries that show up to say the service company now has to spend money to replenish their inventory of tools, and that's going to lead to higher prices. So it's the first thing. You know what we ought to talk about next week on the podcast?
Let's hear it.
I think there's evidence that the DUC inventory is reaching its irreducible minimum.
Ooh, okay.
Which means that oil companies begin to no longer have some big bucket full of drilled uncompleted wells in which to go dip and go get oil and gas.
Well, that's certainly the second half of any forecast for next year because there's two moving pieces, the drilling side and the completion side.
So I think
let's
promise our listeners that we're going to address this DUC irreducible inventory issue sometime soon.
Okay, sounds good to me. In the end, next time we'll also do another Stump the Oil Patch. Okay.
I have a puzzler ready to go right here. Anyway, thanks for listening to The Drill Down. I'm Richard Spears.
And I'm John Spears.